that gold increasingly in the future will be at once a medium of exchange and a store of value, which is another reason why I think you have to own gold. On the one hand, to defend yourself, and on the other hand, as a recognition of the fact that gold will once again fulfill a role in society that it hasn't fulfilled since the 1800s, which is to say, simultaneously a medium of exchange and a store of value. It's very difficult for me to understand why a rational human being wouldn't have a substantial gold portfolio.
I hate making price predictions, but I will tell you $100 silver to me is still undervalued. And it is. It's undervalued geologically, mathematically, and from a standpoint of a depleting asset that has plurality. Gold was $600, silver was $600. Well, it wouldn't be so far out of line because that is the geologic ratio, right? And it's a depleting asset. So if you're mining 7 ounces of silver for every 1 ounce of gold, is it really wrong to think that that has to link up at some point? I don't know. I think higher than people think, I will simply say. And I don't think it'll be much into 2026 before we start to see those kind of prices.
Renowned investor Rick Rule emphasizes the importance of owning gold as both protection and recognition of its returning role in society. He argues that gold is uniquely positioned to function again as a medium of exchange and a store of value, as it did before the 1800s. For rational investors, a substantial gold diversification and long-term wealth preservation. Precious metals expert Andy Schectman argues that silver remains deeply undervalued, even at $100 per ounce. He highlights geological ratios, declining supply, and silver's role as a depleting asset mined at roughly 7 ounces per 1 ounce of gold. Schectman suggests silver prices may rise far higher than most expect, potentially materializing sooner than anticipated as market fundamentals realign. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
They have 2 billion ounces of paper contracts against 140 million ounce float. If all of those contracts stand for delivery, big problem. Okay, that sets the stage. So since July, it appears as though that the 5 big U.S. banks that have been involved have slashed their net short exposure by as many as 22,000 contracts. And so in essence, what they're basically saying about this is that through November and December, it appears largely, if not entirely, that the U.S. banks, these 5 banks, are almost entirely out of their silver short, leaving the foreign banks, the 3 big foreign banks and other commercials with the majority, if not all of the remaining exposure. And that's the big issue here, is who's going to be left holding the bag? The U.S. bank? See, the way that it normally works is you short in New York and drive down the price. You go long in London to offset, but it doesn't affect the price. So they told all of their cohorts, yeah, we got to cover, there's tariffs, ship it back. All this metal's been coming back. It's not tariffs, it's reshoring. And the banks over there, they didn't do that. Some of them have, but there is a big short position that is being held by the European banks, if what I'm reading is correct, from very, very reliable sources. And some of it in that article that basically says that, yes, the majority of the U.S. banks are flipping to net long. And if that report is right, that J.P. Morgan, the biggest of them all, has flipped to net long, I mean, that speaks volumes about where the market is ultimately going. And then let's not forget that as of January 1, China is immediately, if not completely, shutting off exports. They are massively curtailing them, and any export that comes out after January 1 will have to have state trading license through Beijing. This matters, Adam, because roughly 70% of the world's silver is refined in China, most of which historically has found its way back into Western markets. The supply is tightening as the demand is increasing, and there are a couple of big European banks that are short. That the systemic chain reaction of it, the contagion, if you will, is something that I think we're not out of the woods yet. But yes, the banks in the West, in the United States, appear to be running for the hills. The 3 biggest producers in the world in order: Mexico, China, Peru. And I've said on your show and others for the last year that when I talk to guys like Sean Kuhn, the CEO of Dolly Varden, who's told me this flat out, Andy, they're in Peru and Mexico buying silver before it's even refined, in pre-refined stages, in doré and concentrate. Doré are crudely refined bars. Concentrate is a byproduct sludge. So they crudely refine the bars. They send them for full purification refining elsewhere. China says, you know what? We're number 2. You guys are 1 and 3. I'll tell you what, I'll buy all of your doré concentrate. Don't even list it to the West. I'll pay double. We'll ship it back to China and refine it ourselves. They understand this is playing 3D chess when we play checkers. They have for years been buying this stuff before it ever hits the markets in pre-refined stage, trying to disintermediate the information and the market, and they are positioning for the future. Whereas we sit and worry about, but someone got to Trump. I'm telling you, someone got to him at the beginning and said, if we don't do this, we're dead. And the amount of gold and silver coming into this country since November is so historic. It's a year ago now. So historic, it's off the charts. And the same thing is true. They've made it a critical mineral. They've put a floor underneath the price of silver. People need to understand this. So the European Union did it at the end of 23. So did we just now. And China says, okay, fine. We are going to curtail, if not completely eliminate exports. It is a. What's different this time about other times is this is now geopolitical. This is a race between two, sovereign power. And it's not about a couple of brothers trying to exploit the system by buying as many contracts as they can and standing for delivery because they realize the inequity between the bars and the contracts. Same thing we see now, but instead of two brothers doing it on leverage, it's China, it's Russia, it's India, it's Saudi Arabia, et cetera. And now it's the traders here in New York. And the countries that are doing this were never in a position either in any respect, including just the hubris to challenge the West. They're now coordinated and motivated and sophisticated and wealthy and strong, and they're standing for delivery. And then you got the traders here in the West that said, if we don't join into the parade, we're dead. And now you're seeing massive amounts come here. And the people who stand for delivery in hundreds of billions of dollars worth of metal on COMEX, they don't do this for the hell of it. These are the most well-informed traders on the planet. Not the wealthiest, sure, they are, but the most well-informed. And they are always ahead of you and I. They always will be. They're positioned and have been, and China's ahead of them. And so this is a race right now that started out slowly and tiptoeing and, don't tell. And then all of a sudden it's starting to get more and more. But I would ask, where's Jim Cramer? Where's CNBC? Where's Fox? Where's 60 Minutes? Where are any of them? What is happening here? It's just absolute atrocious that the media has not latched onto a story that is as big as anything from a monetary perspective as we've ever seen in our lives, that the whole system is being, in essence, rekindled or changed right in front of us through the massive imports. You don't even hear that silver has been classified critical by the mainstream. They do not tell the public what is happening. And the people following you are so far ahead of the public, it's insane. But that's all you need to see is what the big money does. Don't listen to anything else. The rhetoric will misguide you. Look at what's happening here. And at that level, they don't do it for the hell of it. They just don't.
Schectman warns of mounting systemic risk in the silver market as paper contracts vastly outweigh physical supply. He highlights how major U.S. banks have rapidly exited short positions, while European banks remain heavily exposed. At the same time, China is curtailing silver exports and securing supply upstream, tightening global availability. With silver now classified as a critical mineral and massive physical metal flows reshaping markets, Schectman argues this is no longer speculation, it's a geopolitical race. The smartest money is positioning early, signaling profound changes ahead for silver pricing and market structure. Let's get back to the interview.
Gold does well during periods of time when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. We've already talked about why people need to be concerned about that, because there's a guarantee that your purchasing power in fiat savings instruments deteriorates. With gold, at least you have a chance, and it has evidenced itself as a superior store of value for at least 1,000 years. Importantly, too, with the advent of technology, gold is becoming at once a store of value and a medium of exchange. And let me explain. When you, Daryl, go to buy physical gold at a dealer, whether or not it's in the state of Washington or not, you're probably paying a 3% premium on the buy side and a 3% premium on the sell side. In other words, your transaction cost is 6%. But increasingly, with the availability of digital coins representing gold deposit receipts at places like Tether and elsewhere, you will be able to do that same transactions for fractions of a percent. which means that you will again be able to use gold as money. You'll be able to go to Starbucks and buy a cup of coffee in gold. And Starbucks will be able to aggregate all of those fractional payments and, if they wish, surrender those coins for physical gold, which means that gold increasingly in the future will be at once a medium of exchange and a store of value, which is another reason why I think you have to own gold. On the one hand, to defend yourself, and on the other hand, as a recognition of the fact that gold will once again fulfill a role in society that it hasn't fulfilled since the 1800s, which is to say, simultaneously a medium of exchange and a store of value. It's very difficult for me to understand why a rational human being wouldn't have a substantial gold portfolio. My understanding is that the Tether product is not 100% backed by physical gold or silver, although I don't need to know that to be the case. If you are concerned about, if you're willing to own a gold surrogate as opposed to physical gold, if you want to lower your transaction cost and not have to be worried about physical storage, there is always disclosure of conflict of interest. The Sprott product. The Sprott product is 100% backed by physical. Institutional holders can redeem their trust for physical units, which reduces and often eliminates the arbitrage. In other words, makes the underlying security track the gold and silver price much more efficiently. And the transaction costs on the New York Stock Exchange are de minimis. So the first level of risk reduction, if you want to obviate the transaction cost, the storage cost, and the insurance cost, is probably the Sprott product. I am, as I say, unfamiliar with all of the specifics around the Tether product. I am unsure as to whether the Tether stablecoin is 100% backed by physical gold or silver, and whether or not one can surrender the XAUT for physical gold or silver. If that feature isn't present, either Tether will add that feature or somebody else will create a coin that will allow you to do that. Mm-hmm. Probably the most secure form of storage would be in a vault that was owned by a publicly traded company, so that you could assure yourself that the balance sheet and the income statement of the vault owner precluded you from experiencing the risk of the vault owner stealing your gold or silver. At Battle Bank, my bank, we have insisted that our own gold and our customers' gold be stored at Brinks, precisely because we don't want them to store the gold at home, where they could experience personal security risks, but also because my memory of the 1970s was that a lot of people trusted their gold and silver to storage facilities that then either folded or stole the metal. And I don't want to experience that risk.
Rick Rule explains that gold thrives when confidence in fiat currency erodes, as purchasing power in paper savings is guaranteed to decline over time. With a proven history as a store of value for more than 1,000 years, gold now stands on the brink of renewed relevance. Rule highlights how digital gold technologies and low-cost trading platforms could allow gold to function simultaneously as a medium of exchange and a store of value, a role it hasn't played since the 1800s. He argues that declining transaction costs, secure vault storage, and physically backed products make owning gold a rational defense against currency debasement. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.